Disclaimer.
AG here, and as an Asian guy, I feel uniquely qualified to tell you when other Asian guys are up to something. What China's been doing for the past 14 months should terrify every American holding dollars. Picture this. You're checking your retirement account, feeling pretty good about those numbers. Meanwhile, on the other side of the world, something just happened that could cut the value of every dollar you own by 20, maybe 30% within the next 3 years. And I'm willing to bet you didn't hear a single word about it on the news. November 19th, 2025. While American families carved Thanksgiving turkeys, China and the United Arab Emirates completed the first ever international trade deal that completely bypassed the US dollar. No SWIFT system, no American banks, no dollars whatsoever. They executed billions in trade through a digital platform called mBridge that's been operational for months while our media obsessed over celebrity gossip and political theater. But here's the part that kept me up at night when I discovered it. This wasn't a test run. This wasn't experimental. This was the grand opening of a system that's been under construction for years, and China's been stockpiling the collateral to back it the entire time. 14 consecutive months of relentless gold buying, not slowing down when prices hit $4,000 per ounce, not pausing when Western analysts called them crazy, just systematic, disciplined accumulation like they're preparing for something specific. Let me show you exactly what they did, because most Americans have no clue this is even happening. China's central bank increased their gold reserves from 5.5% to 8.3% of total reserves in just 14 months. We're talking 74.15 million ounces currently sitting in vaults somewhere in China, worth approximately $333 billion at today's prices, around $4,500 per ounce. That's not portfolio rebalancing. That's not diversification. That's preparation for a seismic shift in how global trade operates. You know what separates strategic moves from investment decisions? Investors care about price. They hunt for value, buy low, sell high, wait for dips. China didn't do any of that. Month after month, whether gold traded at $3,800, $4,000, $4,200, or $4,500 per ounce, they maintained systematic buying discipline. Small, consistent additions that accumulated to approximately 30 tons over the 14-month streak, according to official data from China's State Administration of Foreign Exchange. When you see buying that mechanical, that indifferent to market conditions, you're watching someone build infrastructure, not chasing returns. Now connect this to what happened on November 19th. That mBridge transaction wasn't magic. It was the result of years of development by the Bank for International Settlements working with China, UAE, Thailand, Hong Kong, and Saudi Arabia. They spent 4 years perfecting a digital payment system that lets countries trade in their own currencies without ever touching dollars. And on October 31st, 2024, something crucial happened that barely made headlines in America. BIS announced they were stepping away from the project and handing full control to the participating central banks, with China leading the technology working group. Think about that timeline for a second. BIS transfers control on October 31st. Less than 3 weeks later, China executes their first real dollar-free trade with UAE. That's not coincidence. That's a planned rollout, and China has been buying gold systematically throughout this entire development period because they understand something our politicians refuse to acknowledge. Alternative payment systems need credibility, and credibility in global finance still comes down to one thing: gold. Here's what should concern every American right now. According to BIS data, mBridge already has the technical capability to process 38% of global trade flows outside the SWIFT system. Not in development, not theoretical. Operational capacity right now. More than a third of all international trade can bypass the dollar using infrastructure that's been tested and proven. While we argued about domestic politics, China built a parallel financial system and accumulated the gold reserves to make other countries trust it. Pop quiz: what happens to your savings when demand for dollars drops? Your investments are priced in dollars. Your bonds pay in dollars. Your cash holdings, your money market accounts, every number you see on your brokerage statement exists in dollar terms. If international demand for those dollars falls because countries can trade without them, every dollar you own loses purchasing power. Not because you made bad choices, not because companies failed, simply because the currency itself became less necessary to the rest of the world. Let me paint you a scenario that's already playing out. You're a finance minister in Thailand or Malaysia, and you need to buy oil from Saudi Arabia. Under the old system, you convert your currency to dollars, pay transaction fees to American banks, wait days for settlement, and expose yourself to dollar exchange rate risk plus potential US sanctions. Now imagine Saudi Arabia offers you a different option through mBridge. Trade directly in your currencies, settle instantly, pay minimal fees, and hold the excess in gold-backed digital currency rather than US Treasury bonds. Which system would you choose? That choice is no longer hypothetical. According to UAE central bank officials in October 2025, mBridge has already processed hundreds of transactions valued at billions of dollars. Hundreds. Not dozens, not a handful of tests. Hundreds of real commercial transactions, moving billions in trade, flows outside the dollar system, and that number grows every month. World Gold Council data reveals something fascinating when you examine China's buying pattern closely. They didn't accumulate in bursts triggered by specific events. No panic buying during crises. No opportunistic grabs during price crashes. Just month after month of identical purchases, regardless of what gold cost, what stocks did, what the Federal Reserve announced, or what tensions flared between Washington and Beijing. January through February 2025. Gold prices surged past $4,200 per ounce. China kept buying. March through May, prices consolidated. China kept buying. This pattern screams strategic necessity, not financial speculation. You want to know what keeps financial analysts like me awake? It's watching institutional players move with this kind of discipline toward a goal they won't publicly announce. China's not buying gold to hedge against inflation. They've got 36 trillion reasons, that's our national debt, to question whether the dollar maintains its reserve status long term. Every dollar-denominated asset in their reserves, every treasury bond they hold, loses value as we print more currency and expand our deficits. Gold doesn't have that problem. Gold doesn't care about Federal Reserve policy, congressional dysfunction, or American political theater. Remember when the dollar became the world's reserve currency back in 1944 at Bretton Woods? It worked because every dollar was backed by gold at $35 per ounce. Countries trusted dollars because they could theoretically exchange them for gold whenever they wanted. Then Nixon ended that convertibility in 1971. We've been running on pure faith ever since. Faith that America will remain stable, faith that we'll manage our debt responsibly, faith that we won't weaponize the currency for political purposes. China looked at that system and asked a simple question. Why should we trust faith when we could trust gold? Why hold trillions in assets denominated in a currency that loses value every time another stimulus package passes, when we could hold an asset that's preserved value for 5,000 years of human civilization? They found their answer, and for 14 straight months, they've been acting on it with mathematical precision. Here's where this gets personal for your financial future. mBridge participants control $8.4 trillion in annual trade flows, according to data compiled by the participating central banks. Every transaction that shifts from dollar settlement to mBridge settlement represents reduced demand for U.S. currency. Multiply one transaction by thousands happening daily across member countries, and you start seeing how reserve currency status erodes, not through dramatic collapse, through steady, irreversible bleeding as alternatives become more convenient, cheaper, and politically neutral. Imagine you're planning that European vacation you've been dreaming about. You check hotel prices, start budgeting based on today's exchange rates. But over the next 2 years, the dollar weakens 20%, because international trade demand drops as mBridge expands. Suddenly, that $5,000 trip costs you $6,000. Same hotel, same flights, same vacation, but your dollars buy less because global demand shifted away from our currency. That's the hidden tax nobody talks about when reserve status erodes. According to recent analysis by major financial institutions, China's current gold buying pace requires them to accumulate at prices most investors would consider expensive. They paid over $4,000 per ounce for additions during months when gold hit record highs. Normal investors would wait for pullbacks. China didn't wait because they're not investing. They're building the foundation for a monetary system that doesn't depend on American good faith and political stability. What makes this situation urgent rather than theoretical? Timing. China's been operating mBridge with full autonomy since October 31st, 2024. They've been buying gold systematically since late 2023. They executed their first major dollar-free trade on November 19th, 2025. Everything about this timeline suggests they're working toward a specific goal with a specific deadline, probably within the next 24 to 36 months. Think about every major financial decision you'll make over that period. Retirement contributions, home purchases, investment allocations, business expansion plans, college savings. All of those decisions assume the dollar maintains something close to its current purchasing power. But what if that assumption proves wrong? What if we were living through the early stages of a transition, as significant as when the dollar replaced the British pound as the global reserve currency? Some people will read this and think I'm being alarmist. They'll point out that the dollar still dominates global reserves, still powers most international trade, still serves as the world's safe haven during crises. All of that remains true today. But empires don't announce their decline. Reserve currencies don't send warning letters before losing status. Changes happen gradually, then suddenly. And the smart money recognizes the gradual phase while there's still time to adapt. China's not making these moves in secret. They report their gold purchases to the International Monetary Fund every month. They publicly demonstrate mBridge capabilities. They openly discuss reducing dollar dependence in official statements. We're not uncovering some conspiracy. We're watching a well-documented shift that most Americans simply are not paying attention to because it has not directly hit their wallets yet. By the time it does, by the time you notice groceries costing more and imports getting expensive and your retirement account buying less, the opportunity to position yourself ahead of the change will have passed. Official data shows China's gold reserves now represent 8.3% of their total foreign exchange holdings, up from 5.5% just 14 months ago. For context, before Nixon ended gold convertibility in 1971, the United States backed its currency with gold reserves, representing about 15% of total obligations. China's moving toward that ratio with systematic determination, and they're doing it while simultaneously building the payment infrastructure to make their currency relevant for international trade without requiring full reserve status. You know what's brilliant about their strategy? They don't need the yuan to replace the dollar globally. They just need enough countries to use mBridge for enough transactions that dollar demand drops measurably. Even a 10 or 15% reduction in international dollar usage would significantly impact exchange rates, interest rates, and purchasing power for American consumers and investors. We've become so accustomed to cheap imports and low inflation enabled by reserve currency status that we've forgotten how quickly that advantage can disappear when global trade patterns shift. Now let me show you why this isn't speculation or theory. This is documented reality playing out in central bank vaults and payment networks right now, backed by official data that anyone can verify. When I started tracking this pattern, I thought maybe China was acting alone, pursuing some isolated strategy that wouldn't gain traction. I was wrong. Dead wrong. Poland shocked the financial world in 2025 by adding 95 tons of gold to their reserves. 95 tons. For a relatively small European economy, that's an absolutely massive acquisition. But here's what made analysts like me sit up and pay attention. They bought with the same systematic discipline as China. Month after month, regardless of price fluctuations, Poland accumulated gold like they were following a playbook someone else had written. Turkey, India, Kazakhstan, they all exhibited identical behavior. World Gold Council data shows global central banks purchased over 1,000 tons of gold annually for 3 consecutive years running. Not hundreds of tons, not sporadic buying during crises. Over 1,000 tons every single year, with 2023, 2024, and 2025 all hitting that threshold. That level of sustained institutional buying represents coordinated strategy, not coincidence. Let me put those numbers in perspective because 1,000 tons sounds abstract until you understand what it represents. These aren't Western developed economies with established reserve positions. These are emerging market central banks, countries representing 45% of global GDP, systematically moving away from dollar-denominated reserves into physical gold. They're voting with their treasury departments, and the vote says they don't trust the dollar's long-term stability. Imagine you're the central bank governor of Kazakhstan. Your country sits between Russia and China, trades heavily with both, and you've watched Western nations freeze Russian dollar reserves as punishment for Ukraine invasion. You're thinking about your own reserves, your own vulnerability. If geopolitical winds shift and Washington decides your policies are problematic, could they freeze your dollar holdings too? Weaponizing the reserve currency creates exactly this kind of anxiety among nations that aren't firmly in the Western camp. So what do? You quietly start converting dollar reserves into gold, not all at once. That would crash your own holdings and signal panic. But month by month, purchase by purchase, you build a reserve base that no foreign government can freeze, sanction, or manipulate. Gold sitting in your domestic vaults can't be seized by presidential executive order or international banking restrictions. That's not paranoia. That's prudent treasury management in an increasingly fragmented world. Official data from China's central bank reveals something remarkable when you dig into the monthly reports. Small, consistent additions, month after month. Whether gold traded at $3,500 per ounce in early 2024, $4,500 per ounce. By late 2025, China maintained their buying discipline without pause. Over the 14-month streak, they accumulated approximately 30 tons through official reported channels with mechanical precision. You know what that tells sophisticated market observers? Someone at China's central bank has a target. They've calculated exactly how much gold they need, established a timeline for reaching that amount. They're executing with the discipline of a military operation. Price volatility doesn't matter. Market sentiment doesn't matter. Western media criticism doesn't matter. They're building towards something specific, and they're not deviating from the plan regardless of short-term conditions. While China accumulated physical gold, mBridge processed real commercial transactions. According to statements from UAE central bank officials in October 2025, the platform has handled hundreds of transactions valued at billions of dollars. Hundreds. Let that sink in for a moment. This isn't a pilot program running a few test trades. This is operational infrastructure processing enough volume to matter. with transaction counts growing monthly as more businesses discover they can avoid dollar conversion costs and settlement delays. Think about what each of those transactions represents. A Chinese electronics manufacturer paying a UAE shipping company, a Saudi oil supplier settling with a Thai refinery, a Hong Kong bank financing Indonesian infrastructure. Every single one of these deals used to require dollar conversion, generating fees for American banks and creating demand for U.S. currency. Now they settle directly in local currencies through mBridge, and that demand simply disappears from dollar markets. Here's where the evidence becomes impossible to ignore. As China ramped up gold buying in early 2024 and mBridge moved toward operational status, something unprecedented happened to the dollar. According to Federal Reserve data and market indices, the U.S. dollar index collapsed 10% during 2025. 10% in a single year. That's the worst annual performance for the dollar since 2017, and it happened precisely as alternative payment systems came online and central banks accelerated gold accumulation. JP Morgan analysis highlights the correlation. First half of 2025 saw the dollar fall 10.7%, marking its worst first half performance in over 50 years. 50 years. Not since the immediate aftermath of abandoning gold convertibility in the early 1970s has the dollar experienced this kind of sustained weakness during a 6-month period. Markets are telling us something fundamental has changed in global currency dynamics, but most Americans aren't listening because cheap gas and available consumer goods haven't disappeared yet. Major investment banks saw this shift and adjusted their forecasts accordingly. Morgan Stanley now projects gold reaching $4,800 per ounce by the end of 2026. Goldman Sachs set their target at $4,900. Bank of America published research suggesting gold could hit $5,000 or higher if current trends continue. These aren't fringe newsletters making wild predictions. These are the largest, most respected financial institutions in the world, repositioning their clients for what they see as the dollar's structural decline. When banks that advise sovereign wealth funds and pension plans worth trillions of dollars all raise gold price targets simultaneously, they're not chasing a momentum trade. They're acknowledging fundamental shifts in reserve currency dynamics and global trade settlement patterns. Their analysts have seen the same data I'm showing you: central bank buying, mBridge transaction volumes, dollar weakness, and they've concluded this trend has legs. Let me walk you through what this means for regular Americans in concrete terms. You've got retirement savings in a 401k or IRA, probably split between stocks and bonds. Those stocks represent companies that import materials, components, and finished goods priced in dollars. When the dollar weakens against other currencies, import costs rise, profit margins compress, and stock valuations adjust downward. Your bond holdings pay fixed dollar amounts, but those dollars buy less as purchasing power erodes. Even your cash holdings lose value relative to international alternatives. HSBC analysts published a detailed report projecting gold could reach $50.50 per ounce by mid-2026, before experiencing some correction in the second half. Notice they're forecasting $5,000 gold as the midpoint scenario, not the optimistic case. Their baseline expectation assumes continued central bank buying, expanding mBridge usage, and persistent dollar weakness create upward pressure on gold prices regardless of traditional investment demand. Poland's 95-ton purchase doesn't exist in isolation. When you map central bank gold buying across emerging markets over the past 3 years, a pattern emerges that looks less like independent decisions and more like coordinated policy. These countries don't issue joint statements announcing de-dollarization efforts. They don't coordinate through official channels that leave paper trails. But their treasury departments talk, their central bankers attend the same conferences, and they all see the same risk: excessive dependence on a currency controlled by a government increasingly willing to weaponize that currency for political objectives. India ramped up purchases. Turkey accelerated accumulation despite severe currency crises at home. Kazakhstan joined the buying spree. Even Poland, a NATO member with strong Western ties, decided gold reserves needed substantial increases. When you add up purchasing across all these nations, you're looking at countries representing nearly half of global economic output, systematically reducing dollar exposure while increasing gold holdings. Transaction data from mBridge participants shows the system processes trades faster and cheaper than traditional correspondent banking networks. Settlement that used to take 2 to 3 days now happens in seconds. Fees that used to cost 50 to 70 basis points now run under 10 basis points. For companies moving billions in trade annually, those savings add up quickly. More importantly, the convenience factor and reduced political risk make mBridge increasingly attractive compared to dollar-denominated settlement. Imagine you're the CFO of a major Asian manufacturer. You ship container loads of electronics to Middle Eastern distributors monthly. Under the old system, you invoiced in dollars, exposed yourself to dollar-yuan exchange rate fluctuations, paid multiple banks for currency conversion and wire transfers, and waited days for settlement while cash sat in limbo. Now your distributor offers mBridge settlement. You invoice in yuan, they pay in dirhams. The system handles conversion at spot rates with minimal fees, and funds clear instantly. Which system would you choose for your next $10 million shipment? That choice isn't hypothetical anymore. Businesses across mBridge, participating countries, face that decision on real transactions right now, and a growing percentage are choosing the path that doesn't involve dollars. Each company that switches represents permanent demand destruction for U.S. currency. They're not coming back to dollar settlement because the alternative works better, costs less, and eliminates political risk. Federal Reserve officials have started acknowledging the trend in recent speeches and testimonies, though they downplay the urgency. They point out the dollar still represents 58% of global currency reserves, still dominates trade invoicing, still serves as the primary safe haven during market stress, all technically accurate. But 58% used to be 70% 2 decades ago. Dominance is eroding steadily, and recent acceleration in that erosion should concern anyone holding dollar-denominated assets. When Goldman Sachs projects gold at $4,900 and Morgan Stanley sees $4,800, they're essentially forecasting continued dollar weakness. Gold does not rise to those levels in a world where the dollar maintains its current strength and global reserve status remains unchallenged. Those price targets embed assumptions about reduced dollar demand, increased inflation concerns, and continued central bank buying driven by diversification away from U.S. Treasury securities. China's 30-ton accumulation over 14 months through official channels, combined with Poland's 95 tons, Turkey's purchases, India's buying, and Kazakhstan's additions, represent over 150 tons just from those 5 countries through publicly reported channels. Add in purchases from other emerging markets, plus unreported accumulation that likely runs 2 to 3 times higher than official figures, and you're looking at 500 to 800 tons annually flowing into reserves that previously would have held treasury bonds or dollar deposits. That's sustained year after year with no signs of slowing. Official statements from mBridge developers emphasize the platform's ability to handle 26 observer nations waiting to join as full participants. 26 additional countries representing combined trade flows that would push mBridge's potential coverage past 55% of global commerce. If even half those observers activate full participation over the next 2 years, dollar transaction volumes would drop dramatically as trade settlement migrates to bilateral currency arrangements. You're watching the foundation crack beneath reserve currency status. Not through dramatic collapse or crisis, through systematic erosion as alternatives become viable, convenient, and increasingly preferred by nations tired of dollar dependency and concerned about financial weaponization. China's 14-month gold buying streak provided the credibility. mBridge's operational success provides the mechanism. Together, they create an alternative that's real, functional, and expanding. So here's the question that should be keeping every American investor awake at night. Where does this end? Not in some vague future, but specifically. What's China's actual target, and when do they plan to reach it? Because once you run the mathematics on their gold accumulation strategy, the timeline becomes crystal clear, and it's a lot closer than most people think. Before Nixon severed the dollar's link to gold in 1971, the United States backed its currency with gold reserves representing roughly 15% of total monetary obligations. 15%. That ratio provided enough credibility to make other nations trust dollar convertibility, enough gold to theoretically honor redemption requests, and enough buffer to maintain confidence during economic stress. China's studied that history carefully, and they're moving toward that same ratio with mathematical precision. Right now, China sits at 8.3% gold reserves as a percentage of total foreign exchange holdings. They need to reach 15% to match the historical credibility benchmark that made the dollar's gold-backed era work. So let me show you exactly what that requires, because the numbers tell us everything about their timeline and urgency. At current gold prices around $4,400 to $4,500 per ounce, reaching 15% reserves means China needs approximately 3,200 additional tons of gold. 3,200 tons equals 103 million ounces, which at 4,500 per ounce equals roughly $465 billion in additional purchases. Now here's the critical part. At their current pace of accumulating roughly 30 tons per year through officially reported channels, that calculation looks impossible. But China's actual gold acquisition runs much deeper than official reports. Multiple financial institutions, including Societe Generale, estimate China purchases 200 to 300 tons annually when you account for unreported buying through commercial banks, domestic mine production that never hits export markets, and strategic acquisitions through state-owned enterprises. At that realistic pace of 250 to 300 tons per year total, reaching the 3,200 ton target becomes a 10 to 13 year timeline under normal conditions. But here's where the calculation gets interesting, because I don't think they're operating on that 10 to 13 year timeline anymore. Recent events have dramatically accelerated China's strategy. and their behavior suggests they're compressing the schedule significantly. January 2025 saw the Trump administration seize $3 billion in Venezuelan gold reserves held in Western banks. $3 billion of sovereign wealth simply confiscated through executive authority. Every emerging market central banker watched that happen and thought the exact same thing. We could be next. Trump's tariff threats throughout 2024 and 2025 added fuel to the fire. When America weaponizes both the reserve currency and trade access simultaneously, countries face an existential question about their economic sovereignty. You can't opt out of the dollar system if you need dollars to trade, and you can't protect your reserves if they're held in dollars that can be frozen or seized. Gold solves both problems, which explains why buying accelerated precisely as geopolitical tensions increased. My analysis suggests China's actual timeline targets 2027 to 2028 for reaching that critical 15% threshold, which means they're planning to compress what should be a 10-year accumulation into just 3 to 4 years through dramatically accelerated purchasing. This isn't through reported purchases alone, but through a combination of official accumulation, unreported buying, through commercial banks running at 2 to 3 times the reported rate, and domestic production that doesn't hit international markets. Some estimates from institutions like Societe Generale suggest China's real gold reserves might already exceed 5,000 tons when you account for unreported holdings, putting them significantly closer to the target than official numbers indicate. If those estimates prove accurate, China might need only 1,500 to 2,000 additional tons rather than 3,200, cutting the timeline to just 5 to 7 years, even at conservative accumulation rates. Now let's talk about the mBridge system's real power, because this is where trade flows create immediate dollar displacement regardless of how long China's gold accumulation takes. Current mBridge participants, China, UAE, Saudi Arabia, Thailand, Hong Kong, collectively control $8.4 trillion in annual trade flows. 8.4 trillion. That's not potential future trade. That's actual commerce moving through these economies right now, currently settled primarily in dollars. Saudi Arabia's participation changes everything because they control 23% of global oil exports. Now, oil, as you probably know, has been priced and settled in dollars since the 1970s petrodollar agreement. Every barrel of Saudi oil sold to China, India, Europe, or anywhere else required dollar transactions, creating permanent baseline demand for U.S. currency. mBridge breaks that requirement. Saudi Arabia can now invoice in rials, accept payment in yuan, dirhams, or baht, and settle instantly without touching dollars. Imagine you're an oil trader who's structured your entire career around dollar-denominated crude markets. You understand dollar-oil correlations, you hedge currency risk in dollar terms, your contracts all reference West Texas Intermediate or Brent crude priced in dollars per barrel. Then, Saudi Arabia starts offering 5% discounts on mBridge settlements to incentivize adoption. Suddenly, your Chinese buyers want non-dollar invoicing because it saves them money and eliminates conversion costs. How long before your business migrates away from dollar settlement? That scenario isn't hypothetical. It's playing out in energy markets right now as mBridge participants test oil transactions outside traditional dollar channels. Each successful settlement establishes precedent, builds confidence, and makes the next transaction easier. Within 2 years, industry analysts expect 10 to 15% of Saudi oil exports could settle through mBridge, representing roughly $200 billion in annual trade, shifting away from dollar denomination. 26 observer nations watch this development with intense interest. These observers include major economies across Asia, Africa, Latin America, and even some European countries. Combined, they represent potential coverage of 55% of global trade if they activate full mBridge participation. 55%. More than half of all international commerce could theoretically bypass dollar settlement using infrastructure that is already operational and proven. But here's the mathematical reality that major banks are missing in their gold forecasts. Goldman Sachs projects $4,900 per ounce by end of 2026. Morgan Stanley sees $4,800. Those targets assume gold rises on traditional factors: inflation concerns, geopolitical risk, investment demand. They're underpricing by 15 to 20% because they're not fully accounting for the structural shift happening in trade settlement. Let me show you why gold needs to trade significantly higher. If mBridge transaction volumes continue growing at current velocity, the system will process roughly $1 trillion in trade flows by fourth quarter 2026. $1 trillion in commerce moving outside dollar settlement means those businesses need alternative reserve assets to hold proceeds and manage currency fluctuations. Gold becomes the logical choice. Neutral, liquid, universally accepted, impossible to sanction. Supporting $1 trillion in trade flow mathematically requires gold reserves, representing at least 20 to 25% of that volume as backing and settlement buffer. That's $200 to $250 billion worth of gold needed in the system by late 2026. At current prices around $4,500 per ounce, we're talking 55 to 60 million ounces of incremental demand beyond normal investment and jewelry consumption. Central banks are buying roughly 30 million ounces annually right now. If mBridge trade settlement adds another 50 million ounces of structural demand, that's 80 million ounces of combined buying against annual mine production of roughly 95 million ounces. Simple supply-demand arithmetic says prices have to rise substantially to balance the market, not gradually over decades, but within the next 12 to 18 months. Running the numbers forward, gold needs to trade between $5,200 and $5,500 per ounce by fourth quarter 2026 to mathematically support mBridge settlement volumes at projected growth rates. That's 15 to 20% above where banks are currently forecasting, and it explains why current prices around $4,460 offer what might be the final accumulation window before prices break decisively above $5,000 in early 2026. Think about your own financial positioning for a moment. If gold runs from $4,400 to $5,500 over the next 12 months, a 25% gain, what does that mean for your portfolio? If you're holding physical gold or gold mining stocks, you're participating in the appreciation. If you're sitting entirely in dollar-denominated stocks and bonds while gold surges, you're watching that move from the sidelines while dollar purchasing power erodes. Venezuela's seized reserves demonstrate the new rules. Russia's frozen assets after Ukraine invasion showed us dollar holdings can disappear overnight. Iranian banks locked out of SWIFT prove financial networks can exclude entire nations. Every emerging market treasury official sees these examples and adjusts their reserve strategy accordingly, which accelerates gold accumulation and dollar diversification, regardless of what traditional analysis suggests about fair value or overheated markets. China's not just buying gold to eventually maybe perhaps build an alternative system. They've already built the system. It's operational. It's processing real transactions. They're buying gold now because they're preparing for mBridge to scale from billions in transaction volume to trillions, and that scaling could happen much faster than Western analysts expect once network effects kick in. Network effects in payment systems are powerful and nonlinear. Right now, mBridge handles maybe 1% of potential transaction volumes. As more businesses adopt the platform, more banks integrate the technology, and more countries join as full participants, usage compounds. 1% becomes 3%, then 8%, then 20%, and suddenly half the world as trade flows outside dollar settlement because everyone else is already using the alternative system. Your retirement account, your savings, your future purchasing power all exist in dollar terms. If dollar demand drops 20% over the next 3 years because mBridge captures that much trade settlement, every dollar you own loses proportional value, not through inflation in the traditional sense, through reduced international demand for the currency itself. Fewer countries need dollars to trade, so dollars become less valuable relative to alternatives. Banks see this coming, which explains why they're all raising gold targets despite prices already sitting at record highs. They're not chasing momentum. They're repositioning clients for a world where gold provides better stability than dollars, better appreciation than bonds, and better protection than cash. When institutions managing trillions of dollars all reach the same conclusion simultaneously, individual investors should pay attention. We're not facing some distant theoretical threat that might materialize in 10 or 20 years. Based on China's 14-month buying streak, mBridge's operational status, and mathematical requirements for trade settlement backing, the critical transition period runs from right now through late 2027. Roughly 2 years where the current system and the alternative system compete directly, where dollar reserve status erodes measurably, and where positioning ahead of the shift separates portfolios that thrive from portfolios that decline. Gold at $4,460 represents the last accumulation opportunity before $5,000 breakouts in early 2026, followed by $5,500 by year-end if mBridge scaling continues at current pace. Those aren't wild predictions. They're mathematical extrapolations from transaction volumes, reserve requirements, and supply-demand balance. Here's what I want you to understand. This isn't about fear or panic. This is about awareness and adaptation. China's building an alternative to dollar dominance, and they're closer to completion than most Americans realize. You can't stop that process. You can't vote against it. You can't wish it away. But you can position your finances to survive and potentially thrive regardless of how reserve currency dynamics evolve over the next few years. Check your retirement accounts, review your currency exposure, consider whether your current allocation makes sense in a world where dollar demand drops measurably as alternatives become operational. The transition is happening. The evidence is documented. The mathematics are clear. The only question remaining is whether you'll recognize the shift before it shows up in your wallet or after.